Right, should we kick off proceedings? Thank you very much all for joining us today for this global liquidity update. I've got Michael here who will update us on everything. Right, go ahead.
Good, thank you. Good morning, afternoon, evening, wherever you are. Thanks for joining us. This is going to be the first of at least two Zoom conference calls. Next week, we're slated to have another one about the same time, 2 o'clock UK time Wednesday, where I'm going to discuss longer term issues, and I'm going to cover a book called Capital Wars that I've just published with Macmillan, and that really concentrates on the rise and fall of global liquidity. In this particular conference call, what I want to cover is what is going on now, and bring in a number of points about our methodology at CrossBorder markets. What's important? We focus in particular on capital flows and liquidity, and the principles that we use really distill many of the ideas that I learned about markets when I worked at Salomon Brothers from the mid-80s to the mid-90s. I'm going to discuss the concept of global liquidity and then focus on prospects for bond markets, for forex markets, and for equities, and hopefully bring out the point that one of the key assets right now to look at is gold, and why gold could go up quite substantially from here. So let me try and turn to the presentation, which hopefully is in front of you. On the front of the presentation, there's a couple of quotes. One is probably just stating the obvious, that money moves markets. And we're concentrating here on the ebb and flow of capital through world financial markets. But there's a second point that really tries to address the more maybe mundane but academic issues as to why liquidity is important. And what we just stress here is that liquidity is critical in reducing market frictions. When markets are illiquid, you get no transactions. And so investment clearly must be about risk, return, and liquidity. Now you can see this another way, maybe a more straightforward way, by saying, if you take traditional value investing, you look at dividend discount models, how important is the short term to the value in a stock or any asset? And the answer is, for a conventional cyclical stock, something like 12% of the entire value of the company comprises of earnings in the first 2 years of its life. For a growth stock, that's as little as 4%. So the sort of durations that we're looking at in markets right now are really not a lot to do about current earnings. They're much more about factors like liquidity and default risk. And that's really what I want to try and focus on right now. Now, in terms of the background trends here, what this slide is trying to point out is that the coronavirus crisis is just really the trigger for GFC2, or what we've called GFC2. It's a little bit like the Lehman default, or equivalent to it, in GFC1. The problem has been that the world financial system has been operating with a low liquidity safety margin. Now, the little diagram on the top right somehow tries to explain what we mean by this. And what I've shown is a notional liquidity cycle in red, and then a dotted line that's moving from bottom left to top right, that is effectively saying that this is the minimum levels of liquidity that are required for debt rollover. Now, debt rollover is critical here, and it's something which is not really addressed. And that is that if you look at the whopping debt pile that we're accumulating, debt per se is not necessarily bad. Clearly, a rising debt to GDP ratio raises questions about long-term solvency or insolvency, but it's the nearer term problem, finance debt, which is the critical system for the financial system. And that's where liquidity or illiquidity risks really matter. And what I've tried to show as an example here is that with the outstanding debt of $300 trillion in the world economy, with an average 5-year duration, that means that the world has to somehow, or financial markets have to finance about $60 trillion of debt every year. Now, that's clearly quite a problem, particularly if there's no balance sheet capacity. And liquidity is a gross balance sheet concept that basically determines the size of balance sheets. Now, the problem has been made worse because debt is rising. Debt is rising because of the policies that governments have enacted since the global financial crisis. namely austerity, which forces the private sector to accumulate more debt, and low interest rates, which actually encourage them to do so. Partly as well, the rise in debt is related longer term to China and the fact that the rise of the Chinese economy, particularly since the 2001 entry into the World Trade Organization, has basically made production in the West more and more unprofitable. It's created zombie companies and it's caused a lot of debt take-up. That's another issue. Ultimately, in terms of understanding how the world is working, we come back to a model that we use that is shown on the lower flow diagram on the bottom right of this page. Now, this is a bit wonkish, but let me try and explain what we mean by this thing. What we're saying is that the adjustment to shocks, particularly liquidity shocks or productivity shocks in the world economy, operates through the real exchange rate. That's the transmission mechanism that we hold high. That basically affects the private sector first of all. But what it tends to do is tends to drive shocks through not just a change in the nominal exchange rate, but it also changes price levels. Now, the key point that we bring to this argument is that in a world of globalization, many prices and wages are sticky, particularly high street prices and particularly wage levels. And so most of the adjustment that you're getting comes through asset market prices. And so when you get real exchange rate adjustment, what primarily is affected is the level of the nominal exchange rate and the level of asset prices. So in other words, a positive liquidity shock in favor of China because of China's big increase in productivity basically should be raising the yuan real exchange rate. That either means the yuan trades higher in nominal terms or the level of asset prices in China rises. Now, this model is well established. It's very plain across the Asian 2 or 3 decades. It applies to the Eurozone in spades. You can see what's happening there in terms of the productivity shock that Germany has had and the adjustment in asset markets that's being forced through in the Mediterranean economies. As those asset prices fall in the Mediterranean economies, so their collateral is undermined and their banking systems are impaired. What happens currently in the global economy with the shock to China, or the shock from China causing the yuan real exchange rate to rise, is that there is a threat in the longer term to US asset prices. In other words, could US asset prices fall relative to Chinese? Now that's a problem, and because of the financialization of the US economy, the US resists that fall in collateral values by persistently loosening monetary policy. In other words, they'd much rather sacrifice the dollar than they would their asset markets. In the case of China and Asian economies, it's the reverse. They don't want their currencies to appreciate very much, so they go along with the US monetization, and generally you get asset bubbles. That explains the top right-hand diagram, which is then saying you've got a vicious liquidity cycle, but alongside you're seeing huge debt accumulation. That causes periodic financial crises when liquidity comes down. Now, the debt explosion that we spoke about can be seen in the diagram in front of you on slide 3. And just to point out a couple of things. One is that if you look at the accumulation of debt on the top left, the numbers for corporations, industrial corporations worldwide, is absolutely eye-watering. What's happened since the global financial crisis in 2008 is that household debt has actually flatlined pretty much, but corporate debt has actually grown dramatically over that period by something like $60 trillion over the period. So it's more than doubled over that time frame. Now, the other point to note is the lower right-hand chart, which is looking at 2 ratios, debt to GDP, which is familiar, and the other, which is liquidity to debt ratio. Now, that's one of the things that we hold high, and I've put in projections for 2020, which actually don't look too bad. And that's because there is a huge liquidity response to this crisis. Even though debt is going up, liquidity is rising faster. Had that response not occurred, the liquidity debt line would have probably followed the trend that you see from 2010 to 2015. In other words, going downwards. And that is the problem that the financial system continually has to wrestle with, a lack of liquidity to roll over existing debts. Now, how does our framework bring these factors into account? On slide 4, what I've shown is the broad background for liquidity and how it affects asset markets. And let me just focus on a number of salient points. On the left-hand side, we show the main players. Now, of those main players, there's really 3 critical areas to focus on. One is what the Federal Reserve is doing, and that's probably absolutely obvious. Second, increasingly, is the People's Bank of China. Now, I'm going to address that more fully next week on the role of China and China's aspirations in the world economy, and the way that China is trying to unseat the US financial system and the US dollar. And then thirdly, skipping over other central banks which don't really have a great effect on global liquidity, there's this point, offshore pools of funds, things like euro dollars, the growth of FX swaps as a financing vehicle and carry trades. So it's really those 3 factors, the Fed, the PBOC, and offshore pools of liquidity, that are really critical in understanding the equation of global liquidity. And then turning on to the right-hand side, let's call it uses of funds, and that's looking at how domestic liquidity drives bond markets, how relative liquidity, the mix between the private and public sectors, is critical for the forex markets, how cross-border flows coming out of the major financial centers tend to drive emerging market bonds, forex, and equity markets. And then finally, how risk appetite indexes, which we call the positioning of liquidity, which we derive from security holdings data, is really important for understanding the equity framework. I'll address each of those individually. First, on slide 5, what is the liquidity cycle showing? This is the track of liquidity from our database, which goes back to 1965. This is a global aggregate. We show it as an index, which ranges between 0 and 100. But behind this, there are quantities in dollars, in yen, in sterling, in yuan, in euros, etc., showing how global liquidity is moving. But we prefer to use an index because it's much more straightforward to compare both over time and across countries. There's been a very significant expansion in liquidity this year. Actually, even starting before the coronavirus crisis, central banks were beginning to ease in what we call the QE5 process from last September. Last September was a warning shot, which was when the US repo markets dislocated. Many people cite corporate tax payments as the reason. I think there was something more profound there. What was going on was that the Saudis were liquidating very heavily big treasury positions in August, September, after the terrorist attacks on their pipelines, and that put a lot of strain on US funding markets during August, September, and that's what caused the dislocations. And the Federal Reserve basically blinked and began to expand liquidity. And what we see now is a huge carry through. What you normally see is a transmission, as you see along the bottom of the slide, starting with liquidity, moving to fixed income, forex, equities, and then real economies. And the periods in months are normally when those assets get affected by the expansion of liquidity. The heat map on slide 6 is basically saying, here you've got central bank activity, and central bank activity is shown from red to green in terms of its intensity or its ease, a degree of ease. You can see that most central banks latterly are easing them, moving into the green area. There's a couple of anomalies. One is the UK, but the UK has suddenly caught up through April with the unleashing of the Ways and Means account at the Bank of England, which means effectively that the Bank of England is directly financing UK government spending. And China, which is an anomaly, but it's a clear anomaly, and that is that there's not really very much response going on by the Chinese authorities, which I will come on to. This slide on slide 7 is what China is doing. This is showing the PBOC balance sheet on the left-hand side, split between domestic assets in black and forex reserves in orange. The red line on the left is a 6-month annualized rate of change of their balance sheet expansion. The right-hand chart is a daily plot, in fact, a rolling 90-day total of daily interventions by the PBOC in their money markets in terms of billions of yuan or renminbi. And that is effectively modeling what the black area is showing on the left-hand chart. Chinese monetary policy changed very significantly around the end of 2014. Up to that point, domestic assets had not been used as a tool of monetary control. After the opening up of the capital account, the decision to the SDR and the anti-corruption drive, when capital fled China and forex reserves diminished significantly, the Chinese began a policy of actually using domestic assets to fine-tune monetary conditions. That has continued to this day. Forex reserves were historically monetized. They're still monetized to an extent, but clearly they're not anything like the driver of base money in China or the monetary system that they were. Forex reserves at best are flatlining. Real activity or monetary manipulation was occurring through domestic assets very actively through 2015, 16 and onwards. You can see that on the right-hand chart with daily liquidity interventions. The curious thing is that what China has been doing over the course of the last year or so is flatlining liquidity. So you can see that there's virtually no growth in the Chinese balance sheet, PBOC balance sheet. It's stuck at around about 31 trillion yuan. The reason for that originally were attempts to try and control the shadow banking system, which now seem to be successfully done. There's a desire within China not to take on excessive levels of debt, but the importance of the People's Bank in controlling the economy is still critical. And one would expect at some stage they're going to start to ramp up the balance sheet. But the important point is not happening yet. Now, one of the things that I would say in trying to interpret what China is doing is that historically we see coming out of crises, and you can look at 2008 or you can look back at the Asian crisis in '97 as examples, is that China likes to emerge in a very stable way. And it likes to show the world that its financial system, its economy are robust. It will then use that as some sort of lever for influence or soft power after that. And one of the things I think China is seeking to do right now is to maintain the integrity of the yuan against the US dollar. They do not want to see a significant devaluation. And as I've said right at the beginning, in the longer term, what we've got to expect is the yuan US dollar cross rate to begin to rise in real terms over the medium term. Once China has established that line in the sand with the yuan remaining stable, then there is scope for China to ease monetary policy in the medium term. But as that chart on the right-hand side says, there is absolutely no intervention going on at the moment, barring the spike, which you see around February the 9th, which was when the coronavirus crisis in China really peaked. And they did intervene very heavily then, but subsequently everything has fallen away. And every day, if you look at the PBOC website, there was a statement which said, liquidity in money markets is adequate, no liquidity being introduced. What a contrast to what's happening in Western markets. The Chinese financial system seems to be remarkably robust. If you look at this chart on slide 8, it's looking at the degree of interventions that the Federal Reserve alone has made. This is probably not entirely up to date because it changes by the day, but it was up until last Friday. And what it basically shows is each particular intervention that the Fed has undertaken since the global financial crisis in 2008. You can see those listed. The QE5 process, which began from September, ending, let's say, in February 2020 notionally, is about $400 billion. And what you can see then on from the slide QE6 is you're basically seeing there from March 2020 onwards something like $4 trillion of liquidity being shoved in. I've come to that estimate by saying that there's already been a $2 trillion program announced. In actual fact, in the last 2 days, that's been upped again. And on top of that, there was an additional 4.3 trillion potential program unleashed, which is sort of uncapped. But I've assumed that there's a 50% takeoff, maybe heroically, maybe more than that. So that gives something like 9 trillion of injections overall by the Fed, taking it up to about 50% of GDP in total. On the right-hand side, you can see US Fed swap lines to other central banks. That was absolutely critical in 2008-9, and you can see what's happening so far in this current crisis. Dollar liquidity is being promoted by the Fed. They've been faster in their response. They're responding with alacrity in this crisis. They know the fire drill now, and they're definitely using it. In terms of more generally, the liquidity backdrop and what it means for economies, and maybe to bring something in about oil, which I know is a relevant point, and there's been some questions about that. If you look at the left-hand chart, what that's basically showing is liquidity charted against world PMI business confidence measures. The liquidity index has been shifted on by around 9 months. And what it's trying to show is that liquidity is a lead indicator. What it basically is saying is that liquidity is basically liquidity is basically picking up sharply already. And what it is telling us is there is likely to be some sort of V-shaped rebound in economies once the coronavirus lockdown ends. Now, there are obvious caveats one's got to draw here, that there may well be potential supply bottlenecks, but very generally what you're seeing is a rebound in liquidity and a potential rebound in economies. That must be long-term inflationary. Now, I'm going to say a little bit more about the inflationary risks in a moment, but that's one thought to store. Secondly, if you look at the right-hand chart, this is looking at the track of crude oil prices, probably not even up to date, but it was as of 2 days ago. And what it shows is the plunge in oil prices against the track of global liquidity. Now, generally what you can see if you look at the chart is a sort of inverse correlation. And that is that as as oil prices collapse, their demands on liquidity tend to drop. There's a lot of liquidity tied up in oil inventory and in oil production, and it's so significant in the world economy that lower oil prices do have an effect in terms of releasing funds for the financial system. So there is this obvious negative correlation. And what's more, when you tend to see oil prices drop, it's in recessions, and central banks tend to obviously ease during that time. To try and scale this, the fall in oil prices that we've seen down to $20 a barrel has so far been the equivalent on our reckoning of about twice the Fed's March stimulus program. Now, that's not counting what the Fed is doing in April, May, June, but it's saying what we've seen already from the Federal Reserve, something like a $2 trillion increase in liquidity, is something like the boost that the lower oil prices have already given the world economy. That must be short-term cost deflationary for the world, because oil has such an important element in CPIs, but with all this liquidity around, that real money supply growth is going to rise significantly, and you start to see problems in 2021 in terms of inflation pressure. Now let's try and address that, and it's an important issue, and it's an issue which is still, I think, very clouded. The chart on the left-hand slide, which is taken from, in fact, the Capital Wars book I cited earlier on, is looking at the long-term influence on inflation on valuation levels of different assets. And one of the things our research points to very clearly is the fact that inflation is critical to the prospects for real assets and financial assets in kind of different ways. The yellow line is how equity valuations, and take the north-south axis as being a multiple, a PE multiple. It's actually, it's derived from the CAPE estimates of Robert Shiller. And the data, in fact, the yellow line is a direct estimate from the data that he provides on his website. So it's a statistically estimated relationship. The red line is the same for bond yields inverted, and the dotted line is a notional effect for real assets, where what we did is just put a mirror image of the bond line for simplicity. What it basically shows, though, which is the important point we want to make, is that you've got, broadly speaking, two regimes going on. A high inflation regime where real assets do well and financial assets in general do badly, although equities do less badly than bonds, and a low inflation regime where financial assets do famously well and real assets don't do so well. There's also a sub-period when you get sub around 2%, when bond and equity markets decouple and equity markets and bonds have negative correlations, and a period higher than 2% inflation when bond and equities have positive correlation. Now, I still think that we're in this low inflationary environment where we're moving up slightly within the context of inflation cyclically, but I still think the overwhelming background is one which tells us that disinflationary pressures are there because of demographics, because of China, and because of technology. But there is a cyclical surge maybe coming. And that cyclical surge is shown by looking at US money supply growth at the M2 level. Now, we're not really devotees so much of money supply. We look at liquidity, which in contrast to money is an asset-based definition. And one of the problems with money is that money as defined by monetarists is really a funding concept. And the world has moved on from using money or bank deposits as a fund, as a source of funding, because there's many, many other forms of funding that go on. But notwithstanding, for these purposes, money supply may be a useful factor to look at. And what I've tried to show is that the sort of levels of monetary growth that we're currently seeing would suggest that M2 money supply in 2020 in America could be as high as 20%. Now, if you look at where monetary velocity for M2 is, it's at low levels already. It's only about 10% above its all-time low, which was reached at the end of World War II. So there's not much more that monetary velocity could really fall. And if you said that the trend in the economy is around, at best, underlying trend, ignoring this recession, of course, at best 2.5% to 3%, then you can see there's a lot of potential there for consumer price inflation to pick up. And I wouldn't be surprised if you saw CPI in the US moving up to about a 5 to 10% band sometime in later 2021. And that's clearly a risk. Aside from the deflationary pressures now, there's a problem coming. There were a number of questions related to inflation and related to these money supply questions, and let me just sort of pick up a couple of those now. One of those is basically saying, will this pass through to the real economy, or will it be basically absorbed by bank reserves? I think one of the things to point out that even in the last 4 weeks, you've seen a huge rise in lending by US banks. There's weekly data from the US, and what they show for 4 weeks is there's something like an 800 billion increase in lending over that period, which is basically equivalent to a year-over-year growth of about 11–12%. So already lending in the US is picking up substantially, as you would expect. The other thing to say about this is that most of the growth in money is occurring at the retail level, in other words, narrower aggregates, and not at the wholesale level, which is basically more important for financial markets. The retail level is likely to be spent. And unlike GFC1, where the banks were the problem, in GFC2, the banks are the solution, and they're being encouraged to lend. So I think that this money will be going through rather faster than maybe some people would suggest. And that has got to make us wary on inflation. The whole point about the discussion on velocity, which is something which we also got a question about, is that we tend not to look at velocity so much because it's really a muddied concept. It basically combines both the use of a measure of the use of funding, deposit funding for credit, and a measure of the productivity of debt in one. And so we find it not particularly useful. But broadly, you would expect velocity to move with the price level. That was one of the things I think was implicit in a lot of the work that Milton Friedman did in his big study of US money back in 1963. And one of the things that was sort of implicit in that is that velocity is stable during periods where you have a stable exchange rate regime. If the dollar starts to fluctuate, then you are much, much more likely to get unstable velocity, which is what history outside of that period tends to show. Looking at the implications for bond markets, which is shown on slide 11, what that illustrates on the left is global liquidity, basically for the G4 economies and the growth rate in their central bank balance sheets. The yellow line is the weekly 3-month annualized change, and the red line is the global aggregate of what those central banks are doing. The chart, broadly speaking, lines up. You can see the huge spike recently. That's clearly going to be sustained for some time. What does it mean for bond markets? Well, this is where we get very troubled, because if you look at the transmission mechanism, the transmission that we look at is via the yield curve, and in fact via term premium, which I'll come on to. And the chart on the right-hand side is looking at the G4 yield curve, which is the yellow line, and the red line is global liquidity advanced by 9 months. And what this is basically telling us is you should be seeing the beginnings of quite a noticeable steepening in yield curves. And that's the troubling aspect. That steepening of yield curves, assuming that the front end of the curve is anchored by policy rate decisions, is going to be meaning that you get rising long-term yields. Now, how is that going to come about? Well, first, what is the relationship and how robust is that? Well, here is a statistical, again, maybe slightly wonkish, but it basically shows the track for US data on US liquidity in orange on that left-hand graph, and the US 10-2 yield curve over the long term with the regression statistics, and at the bottom, a Granger causality test, which basically is showing that unmistakably, liquidity conditions are one-way Granger causal with great significance. The evidence recently, or what's happening recently, we're going to use evidence from the period since the GFC on the left, and the longer-term track of data on safe asset provision on the right. The left-hand chart is looking at the US term premia on the 10-year treasury note rather, over that period in orange. Now, this is very similar to the data that is created by the New York Fed by Adrian Crump, Mills, and Moll, that model. It's actually data that we've calculated ourselves using a similar methodology. We've used our own calculations because we've taken that right back to 1946, which is what the data on the right will show. But the principle initially is that during periods of QE, as shown by the shaded areas, what you find is that term premia tend to rise. Now, the rationale for that is very straightforward, and that is that what the Federal Reserve is doing by adding liquidity is reducing systemic risks in the financial system. It's reducing default probabilities, and therefore the demand for safe assets, of which the Treasury note is the canonical example, drop away. And even despite the fact that the Federal Reserve through QE is buying 10-year treasuries, that is a very small effect relative to the collapse in demand for safe assets as a result of Fed actions. Now, we can take that a stage further by plotting the term premia over the long term, which is the orange line on the right-hand chart, against the supply or the excess demand or excess supply of US safe assets. Now, what I've taken as my demand measure is the Fed balance sheet, to say that with a bigger Fed balance sheet, the demand for safe assets by the private sector drops away, and the issuance of US treasuries, which is the straight supply of safe assets. So looking at the sum or the average of the increase in US safe assets, in other words, the Fed balance sheet plus the Treasury stock, is that black line. The correlation between the two series is compelling, and it goes back a long way. And if you want the regression statistics, the answer is the R squared on that equation is about 0.44. And even since 2010, despite the recent disconnect, it's about, so it's very high. The interesting point to note is that many people argue that the US will adopt yield curve control and it will basically be able to manage a cap on long-term yields. I doubt that seriously, and there are two reasons. One is that if you look back to the period of yield curve control, which was before the Treasury-Fed Accord in March of 1951, the Treasury-Fed Accord basically freed up the bond market to the private sector. The Fed stepped away. From 1942 until 1951, the Federal Reserve capped long-term yields at just over 2% in the US. Now, the interesting thing is that that was a successful policy. One reason was that there was a huge collapse in Treasury issuance from the end of World War II until the early 1950s. And you can see that by the black line collapsing. So the Federal Reserve was operating through that period, controlling the bond market when the supply of safe assets was collapsing. The second reason is shown here in these pie charts. And that is that the nature of ownership of the Treasury market has changed dramatically, and the nature of banks' balance sheets has changed dramatically between 1945, when yield curve control was being applied, to 2019. Now, I draw this analogy because it's kind of similar to what's going on in Japan right now, because the Japanese are also adopting yield curve control, but there's a lot more influence that the Ministry of Finance and Bank of Japan have over the Japanese financial system through moral suasion. The top left-hand chart shows Treasury ownership in 1945. What it's showing is the Federal Reserve only owned 1% of the Treasury market, foreigners owned barely 1%, and the banks owned over 40% of the outstanding Treasury market. In 2019, the banks have more or less been replaced in their slice by foreigners. So you can control US banks in 1945, probably now, but you can't control foreigners that easily. And so they might get skittish in a period where the US fiscal accounts deteriorate. If you look at the right-hand charts, pie charts, you can see there that in 1945, Treasury holdings made up the predominant slice of banks' balance sheets. Today, they're relatively small, barely 4%. So loans make up a much, much bigger slice. So you can see that the dynamics of the Treasury market are way, way different today than they were in the immediate post-war period when yield curve control was successful. So I'm very skeptical this will work, and I think there is a risk at the low end of the bond market. Turning to the outlook for the US dollar, what these two charts are looking at is some prospects for the dollar, first of all, against the yuan in real terms, which I cited at the beginning of the presentation to say the yuan-US dollar cross in real terms must be rising in favor of China over the medium term because of this big productivity shock. And what you're likely to see is that trend continuing in the medium term. There's been a near-term lull or setback, but I would suspect that is temporary. If you look at the right-hand chart, this may look a rather odd cross to look at, but it's one that we favor. This is the bilateral cross between the Swiss franc and the US dollar in real terms using BIS data. And what this basically illustrates is periods which seem to be almost exactly 15 years of a cycle between the two currencies. We've chosen the Swiss franc because trade doesn't really influence the cross rate between the US and the Swiss franc, whereas capital flow is by far and away the dominant influence in that cross rate. And so what this chart is basically telling us is how capital is entering or leaving the US compared to Switzerland. And what you can see in the chart is it looks as if the dollar cross is rolling over against the Swiss franc, and it's sort of satisfying that long-term downward channel. And that may tell us that the dollar is near a peak value. Now, further evidence comes from looking at slide 16, which is our data on capital flows. We look in particular at the mix of liquidity, which drives currencies not just the dollar, but generally different cross rates. The yellow line is looking at private sector liquidity on the left-hand graph, and the red is Fed liquidity. We know Fed liquidity is slated to rise even faster, and it may well be that US private sector liquidity collapses as the US economy hits recession, as happened in 2009 after GFC1. What's important for the dollar is the difference between those two series, the spread, if you like. And that is because private sector liquidity, more of it, drives the dollar higher, because people like a US economy that's cash generative. If the private sector is throwing off cash, growth is good and the return on capital is good. Whereas if the Federal Reserve is printing money and supplying dollars, it's a bad thing for the currency. So think of this as being good liquidity in yellow and bad liquidity in red. And it's the crossover that's important. Now, we use that crossover to define our Forex risk index. And that is shown on the right-hand chart, advanced by 12 months in red, and it's charted alongside the deviations from trend in the trade-weighted US dollar, DXY. And what that basically shows is not a bad fit at all. I'll show you the statistical properties in a second, but it's suggesting that the dollar is coming near to a peak. Or downward pressure on it. This is the statistical relationship. Again, you've got Granger causality statistics at the bottom, very clearly, dominantly one-way Granger causal over that period, and the fit is shown there. So a large part of the variation in the US dollar, in this case, is determined by the Forex risk index, which is the differential between private and public sector liquidity. And we make that distinction between types of liquidity, quality types, whereas conventional monetarists just keep everything into one bucket and say more liquidity, dollar goes down, less liquidity, dollar goes up. It's not quite as straightforward as that. It's the mix that's important. Let me add a point about emerging markets, which may not be apparent from some of the sort of scare stories that are hitting the media. What this chart shows here on the left is capital flows to emerging markets, and on top of that, financing conditions. We've shown this as a hybrid index, and I've compared GFC1, which is the blue line, with GFC2, as we called it now. What you saw in GFC1 was a very clear deterioration in EM financing conditions. Doesn't seem to be happening in GFC2 so far. Now, that may seem a heroic statement, because in the wake of the crisis, there have been report after report of portfolio outflows from emerging markets. And that may well be true, but you can also take into account what's happening to credit inflows. And balance of payments must balance. So if you've got a big portfolio outflow and you've got no particular rundown in Forex reserves or no big deterioration in trade balances, by definition, it must be funded somehow, and that may be funded through banks and credit lines. And so what this is really saying is that actually the banking mechanisms at the wholesale level, at the cross-border level, take it at the Federal Reserve swap level, still seem to be working. So this crisis is not about wholesale lending problems in the financial system. It's much more granular. It's much more down at the retail level. On to equities. How do we look at equities? Let me just say a few words about the methodology. What you can see on the left-hand graph is a measure of world wealth. This is a track of a lot of data on our database across 80 countries, shown in millions of dollars. And it basically illustrates the backdrop in terms of where we are now, in terms of holdings of investors in liquid asset terms for fixed income securities of all types and equity holdings of all types. And that is a short $250 trillion split in that way. Now, what we show on the right-hand chart is that the allocation to equities relative to fixed income is actually remarkably stable over time for world investors. In fact, if you drill down to individual economies, it's also the same. It's remarkably stable. That's because you've got disciplined asset allocation processes where investors are, say, following either a 60-40 rule, or on average for the world economy, they're following something like, maybe a 45% bond, 35% equity rule. One of the things that to point out is, whereas in the West, equity allocations are high, in the East and Asia, you tend to find that equity allocations are lower and cash and bond allocations are much higher. So for the world overall, what you're finding is that this is an average of equity exposure relative to fixed income, average around minus 10%, but with big cycles. Now, we can go a step further and we can use this data as an investment indicator, because we can see its mean reverting. And what we show is a normalized data plot on slide 20, which is basically showing this data. In fact, it's more comprehensive data, including corporate debt, including cash, etc. And what it illustrates, with a mean of 0 and 2 standard deviation bounds at 40 and minus 40, it shows how, let's call this risk appetite, the appetite of investors for equities and corporate bonds, shifts relative to their portfolios. So we're looking at that differential between risk assets and safe assets. And so you can take this as an actual track of the risk appetite or risk-seeking activity of investors, a good measure of risk on, risk off. Now, what the data shows here is that on average, average returns looking ahead 2 years from world equities over the last 20 years were at an annual rate of just under 7%. If you'd have had an investment strategy that only invested when that orange line was 1 standard deviation below its mean, you would have been investing only 39% of the time, but your average return on average per year over a 2-year horizon would have been about 25%. So a significant difference by not going with the crowd, by basically shorting euphoria and going long at pessimistic extremes. Now, where are we now? Well, let's just show what the data is showing. The left-hand graph is the mountainscape, which shows the value of global financial assets. And the right-hand chart is the track of the risk appetite index in red. And what we've also done is to plot it against world economic growth, which is the yellow line. Now, what this chart shows is that asset allocation, in other words, moving to risk and out of safe assets, is very pro-cyclical. It moves with the business cycle, as one may reassuringly suspect, but it overshoots significantly. And it's those overshooting points that we need to think about seriously. Now, where we are now is at very low extremes. That's suggesting a very severe recession upcoming. But we've got to look at this in context. And looking at slide 22 shows risk appetite for the major markets. And one of the things that we've been pointing out is that risk appetite in the US in particular has really been hammered. There have been dramatic shifts out of risk assets into safe assets. The accumulation by US money market mutual funds over the last few weeks has been almost as high as $1 trillion of cash inflows. So people have definitively been moving out of stocks. And the US market definitely was looking oversold in this context. You've never seen on that track periods of risk appetite, in other words, deviations of equity holdings, risk asset holdings relative to safe assets, anything like these extremes. And by all accounts, this should bounce back. And Eurozone is not dissimilar, Japan rather less so. And had I put China and emerging markets up, you'd have seen probably data not dissimilar to where the UK is there. But generally, asset markets or equity markets look appealing on this view. Here's a slide for reference in this, how well this strategy has worked historically. What it says is, first column, if you'd have invested in equity markets when the risk appetite measure was above 40, your average 2-year ahead return would have been minus 16%. If you'd have invested when the risk appetite index was below 40, your average 2-year ahead return would have been plus 33%. So it's very straightforward, linear. or virtually linear increase across that period. You want to be buying equities when risk appetite is low, when investors are positioned to have a lot of cash in their portfolios like now. You don't want to be buying equities when they've got little cash, because shocks happen. Summarizing, how does this work? Liquidity moves from bond markets and currency markets through to equity markets and then to the real economy. That's the sequence we see. Nothing from what we can tell at the moment would suggest that's not likely to happen this time. So we think, in summary, that you want to be positioned towards equity markets. You want to be thinking about reducing bond exposure over the next few months. Bonds may do well in the near term with a deflationary shock to oil, but longer term, I can't see how they're going to perform. Gold is clearly a very good asset with all central banks pumping in cash. Dollar, as I said, is likely to peak, and the world economy is likely to see rather more of a V-shape than an L-shaped recovery, although, you know, one's dancing on the head of a pin a bit to say that it's going to be one or the other. Summarizing, where are we? Well, I put a sort of foretaste of next week's presentation on capital wars on the left. That's the book that's published by Macmillan, available now, which is really about the rise of global liquidity. And what it talks about is the impending tussle, or maybe not impending, but ongoing tussle between China and the US. And what we've said here is that the future is all about capital wars and the secular rise of the Chinese root exchange rate, which really has to happen. In summarizing where we are in the conclusion, we think investors underestimate the scale of monetary easing. There's about a 40% increase likely to occur in global liquidity. I've tried to show that risk aversion, particularly in equity markets, is at extremes still. It's very curious that the PBOC is not joining in, but I think what they want to do is to try and establish their soft power while the US balance sheet is expanding and testing maybe as much as 8, possibly even $10 trillion. This is not like GFC1. Wholesale markets still appear intact, and it's the retail or possibly even the emerging market level where there have been bigger question marks. But we think emerging markets remain intact. The US dollar is near a peak, as I said. Bond yields could test 2% in the US if our expectations about term premia are correct. And that would say a 30% increase in safe asset supply is likely to push term premia up by that amount. And equities look attractive, and we still think US stocks have been hit rather undeservedly over the period. There may be wobbles over the next few weeks, but generally, from a 2-year ahead view, it looks attractive. Now, there have been some questions. These are just a list of our reports in recent weeks, but there have been some questions. One of them I know came from Sujata Reuters, which was basically about financial conditions and to what extent does liquidity reflect that. What I've tried to show on this slide is the difference between liquidity flows and financial conditions. Financial conditions are basically all about measures of interest rates, exchange rates, and, if you like, what people generally call market liquidity measures. Our liquidity measures in blue are much more about funding liquidity conditions. The two are different. Funding liquidity, if you look at the chart, tends to lead typical financial conditions indexes, which are, these we use, not dissimilar to the ones Bloomberg create or Goldman Sachs use or the IMF uses. And what you can see from the orange line is that, notwithstanding some of the easing measures that have been undertaken, there's been a recent setback in financial conditions or market liquidity measures. Better than it was maybe 6 months ago, but still coming down. But liquidity is moving upwards relative to that, and therefore you'd expect funding conditions or financial conditions to improve. On the right, just for reference, I show measures of investor risk appetite, the same things that we were looking at a second ago, against funding liquidity, to show that it's often moving in opposite directions, but that's actually part of the attractions of these two series. And ultimately, what you really want to do is to be buying risk assets when the blue line is above that orange line. when you've got more liquidity coming into the system and you've got risk appetite at low levels. And this should be a great conjunction right now. Some of the other questions we've had, I think I've addressed some of them. One is on bonds and term premium, which I think I covered, but it's really a point about how soon the term premium pick up. Well, the normal lead time is around about 6 months. There was a question on the dollar about would we expect private sector liquidity to fall away rapidly? The answer is probably yes. And we know that Fed liquidity supply is picking up fast, and therefore the lead time for outflows from the US dollar could be in the order of 3 to 6 months, that sort of period. There was another question which I know was about risk appetite and whether the Federal Reserve would control or support risk appetite. Let me show you this interesting set of charts which come from another presentation we've been doing, which is concerning one of the funds our asset management division runs. And this is looking at the momentum of GDP from nowcasting measures in GFC1 and in GFC2 on the upper and lower slides of that left-hand chart, or the left-hand side of the chart. The top chart indicates what happened after GFC1, and you can see there after the hit, which affected economies according to nowcasting around about December 2008, let's say, or significantly then, there was a slow climb out, or maybe not so much of a slow, quite a reasonable climb out, V-shaped climb out from around about April 09. Now, if you look at what's happening now with latest nowcast data, these are all daily numbers. What you can see is that the world economy was adversely affected from about the middle of February. It remained low. There was a jump, and that jump in activity is really China related. And what that is really showing is that there are two cross currents here. One is that the Chinese economy is picking up, but that's being sort of overwhelmed by a lot of the latest data coming in from Western economies, which is showing deepening recession there. So the net of the net is that there are, unlike 2008, where the world economy was basically moving in one direction, the cross currents now are causing that to be rather choppy. And it may be that it takes a little bit of a while before that yellow line begins to pick up. The movement in risk appetite is equally interesting. And if you look at the charts here, this is up until early April data for 2020. But the top chart on the right is looking at risk appetite numbers. And what the risk appetite numbers are basically showing is after 2008, there was a very slow climb in risk appetite. It was still well below normal levels right up until well into 2010, 2011. The normal level is about 0. And the time we get worried, by the way, is when it goes to, as we've said, plus 40. So we're a long way away from that. There was a great investment opportunity through that period. And then if you look at the bottom chart, it's showing how investors' risk positioning has changed or not changed since the crisis started. And the answer is it's barely changed. Investors still have very high exposure to safe assets. And that augurs pretty well for risk asset returns in the medium term once the economy begins to pick up. So let me stop there. There may be some follow-up questions. I don't know if I can see any, but I'm sure.
Yes, well, I know there is a couple of questions. So what I shall do, if you guys would like to either wave me down or put into the chat that you would like to ask a question, I can then sort of patch you through. We'll do it one by one. So I know that George Noble, you have a question. So I will just unmute you now, George. Over to you.
Michael, hey, great.
George, how are you?
Very well, excellent presentation, much appreciated. So I gather you think it's a very good environment for putting on risk right now.
About right now, but I think on a maybe 3-month view, yes.
Okay. Why isn't this like the ultimate best scenario or situation for gold? Gold to me, gold in my view is sort of at the top of the pile right now. Could you elaborate a little bit more on gold? To me, it seems like the most interesting investment play at present.
Yeah, it is. I mean, I didn't say very much about gold because I think it almost is so obvious. I mean, it's the asset class that, you know, with these sort of monetary growth figures you can see on the right-hand slide here, U.S. money growth, or even if we go right back to looking at you know, general global liquidity. I mean, this is an environment where gold should excel, absolutely. Now, there are a number of factors to think about in this. You know, one is, and I know there was another question about this, is that if you get deflation near term in the oil markets, will that dent the prospects for gold? The answer is no, because what gold is reflecting is monetary inflation and not high street inflation. If you think high street inflation, it's a hybrid between cost pressures, which are coming from things like oil or productivity, and monetary factors that are reflected by gold. Gold is a pure monetary phenomenon, and if central money with alacrity, as if it's going out of fashion, you're going to get a rising gold price. So absolutely, it is top of the pile, and I don't think it will be dented by concerns near term about you know, deflation in oil. In actual fact, rather the opposite. If you think that this deflation is bad for debt, which it may well be in the short term, and will cause even more liquidity response, then I think it's something to think about. Now, the other thing that I would say in that context is, if you look at the history of responses, and if you look at the Federal Reserve in particular, the Federal Reserve actually has 3 remits, not 2. Its 3 remits are employment, inflation or stabilizing the dollar, and financial stability. After each crisis, such as recession, such as inflation, or such as financial instability, the Federal Reserve focuses very clearly on that particular dimension of its remit. So after financial instability, it will, as history shows, ignore the inflation element and will focus absolutely on getting the financial system back. And if that requires more liquidity, it will do that. So I think it will require more liquidity. And therefore, what I think is that the gold price moves up substantially from here. Now, does that, and the other thing I should throw in, which maybe is in the realm of conspiracy theory, but could not be true, is that who owns 20% of world gold stock? The answer is Russia and China. They've accumulated that over the course of the last decade or so. And there must be sinister reasons for them doing that. China has a stated aim of wanting to unseat the US dollar as the world standard of value. And this is a great way of trying to do that. So I think that gold is definitely an asset to own.
That's fantastic, Mike. If I just follow up, clearly you're positive on equities as well, but you just mentioned this in your answer about gold, or when I threw the question out, not necessarily right this minute. Is that because it's had a good run, or what gives you a little bit of pause on equities when I asked you about equities?
Oh, I think because I think equities. I think what we may be getting near term is, you know, a bout of bad news on economies, and equities have had, you know, rebounded significantly already. I think the financial system has been stabilized, and that's what the Federal Reserve and policymakers want. I don't think that they're going to be too concerned if the equity market, you know, sells off 2% again. I think it's trying to form a bottom right now. And, you know, I wouldn't think there are big drops coming, but I think that, you know, we're trying to put that floor in. And I think rather like 2008, what you'll see is a progressive increase in money coming back into equities once you see economies stabilize. In 2008, we saw that stabilization beginning around April 2009. So from the shock, it took about 6 months. I think the difference this time is that China and Asia are probably already out of it, so it may come rather sooner within a 3-4 month period.
And then last question, not to filibuster, but there was no mention of only passing reference to oil, which is in its own little world.
Well, I think it is its own little world.
Always
I think it's very difficult to make any sense of oil. It's a political decision. The or political issue. I mean, the problem is that the Russians, shot themselves in the foot, so to speak, with this particular episode. They will do I'm sure, all they can to try and slow down or try and slow down oil supply. It's going to be very difficult, as you know, in the near term. Storage capacity is absolutely full. So I think you've got more volatility in the oil market to come. But I would suspect that there will be attempts to try and restore the previous oil price at around about, circa $40 a barrel at some stage. I wish them success. But, in the longer term, it's the gold oil ratio which tends to be the critical thing to look at. And what that would tend to suggest anyway is that the gold price has got to go up a lot more from here. Any other questions?
Perfect. Thank you, George. Yes, there are a few other. Our next question is from Jun. I don't think they're still on the line. So the next one would be from Sandeep Tandon. I'll just put you through now, Sandeep. Yep, all good to go, Sandeep.
Yeah. Hi, Michael. Thanks a lot for a wonderful presentation. I have two specific questions. Is any of your parameter can help us in predicting or forecasting the global volatility on various asset classes? That's one. And second thing, given the background you're talking about a weak dollar index, so how you look at the impact on the emerging market pairs, particularly India and China?
Okay, right. Let me talk about the second first of all, about emerging market currencies. If you and I should have spent a little bit more time on emerging market currencies because there's a lot of charts we got on those, but I haven't got them in the presentation. The issue is that if you go back compared to previous crises, one of the things is that emerging market currencies prospectively look a lot more stable this time around than they have in past crises. And there are a number of reasons for that. One is that I said that earlier on that funding lines still seem to be open. And secondly, there's not been the deterioration at the local economy level in many emerging markets that we saw around previous economic crises. So in other words, this is not because the world economy is overheated and you've had financial imbalances in these economies that have spilled over into currency markets. This is very different. This is much more a funding or financing crisis that we've seen, and I think that despite the sort of the fears that investors have got, those funding issues have been reasonably well dealt with. I would suggest. I think looking forward, maybe looking at India and other regional currencies. I mean, I think what we're looking at on a longer term view is a period where you're likely to see the development of currency zones. And that currency zone in Asia is increasingly likely to be dominated by the Chinese yuan. Now, there's a number of points to note about that. One is that clearly China would like that to happen. And the other issue is what's been happening to Asian currency units over the last 2 or 3 years. And it's very clear to me, if you look at the volatility of Asian currencies against the yuan or against each other, it's dropped away very significantly, almost as if there is deliberate currency targeting going on. And you can see that in probably the biggest of the other currencies in the region, which is the Japanese yen. The Japanese yen has moved in a way that I've never seen before over the last 2 or 3 years. And it really looks as if there is deliberate targeting going on of the yen cross rate, and that seems to be that what you're looking at is the gradual evolution of a yuan-based currency zone within the Asian region. Now, the Indian rupee may be in that, it may be outside of that, but I think it's got to pay attention to that. And broadly speaking, of the regional currencies we look at, and notwithstanding the fall in oil, the rupee has been the one that we've been most concerned about, largely because the Reserve Bank has been operating a pretty loose monetary stance in India, looser than perhaps the rupee would like. Now, turning to your first question, which I've partly forgotten, but it was about how to use this framework to predict asset markets. Was that correct?
how to predict in terms of gauging the volatility of various asset classes?
The volatility of asset classes. Okay, yeah. Okay, well, let me draw on that. The volatility question is a huge one. One of the things that we first observed, I say we in a general sense, when I worked at Salomon Brothers, was a concept which we sort of loosely called the law of conservation of volatility. And that basically said that if you look at volatility patterns across asset classes, there is a very clear sequence. The volatility begins in the Forex markets, it tends to migrate to the fixed income markets, and it ends up in the equity market. So it's kind of like squeezing a balloon. Now, it hasn't entirely been the case this time around. It's not always the case, but that's generally speaking the sequence. And that's typically the sequence that you see, in fact, on the bottom of that slide. Now, if you look at, therefore, what's likely to happen, one of the reasons that you've seen low volatility over recent years is there's been actually a great degree of low currency volatility, which has translated into low Forex volatility, which has meant low equity volatility. So I think coming back to the issue of general volatility in asset classes, the first point to note is that you would likely see a sequencing moving from Forex markets outwards. If Forex market volatility is low, and I would suggest that what we're seeing is increasingly a world of currency zones where volatility between zones may be higher, but volatility within a zone will be lower, that will tell you something about the relative volatility of different assets. Moving on from that. The second associated point is a more specific one, which relates to market making and relates in particular to equities. One of the things that you've seen in markets over the last decade or so is a very clear pattern in crises, and that is that equities or risk assets move upwards rather like climbing a very gradual slope, but they hit crevasses where they crash down and then rebound very fast up the other side. Now, that particular process is all to do with the market making system, and it's all to do with a lack of liquidity and how the liquidity arrangements operate in markets. Increasingly, it's not banks that give out credit per se, it's effectively collateralized credit. So what goes on is that during periods where you find market sell-offs and where the value of collateral deteriorates, you get a further feedback effect, which causes credit to diminish even more because market makers can't get the credit or the loan on collapsing collateral, and they step away from the markets. So what you've seen time and time again, and this is a great example right now, admittedly it may have been triggered by the banks, because what happened was that with the coronavirus crisis, there was a period where you saw precautionary cash demands picking up. The banks couldn't meet those without taking money away from market makers. They probably cut back on market maker loans. Market makers tried to get credit through collateral. Markets began to collapse. They found that avenue lost, and therefore they stepped away from markets. And as they stepped away, market liquidity just crumbled. And so what you see is this very sharp crevasse. So I think that's the process we're in. So I think that understanding liquidity is critical for that. On a medium-term standpoint, look at sequencing. On a short-term basis, look at the whole structure of liquidity and how collateralized lending is important. We'll see more of these crevasse-like shocks over time, which is why any good sort of fund product has got to have an element of volatility in there. Our investment management operation runs a fixed income volatility-based fund, and what it does as a strategy is to buy volatility when it's low and to sell it when it's high. It's just a value-based strategy for volatility. Any more questions?
Yeah, we do have a few more. So the next one is from Stephen Anthony. I will just patch you through. I think he has left. So the next one we have is from George Fox, although he says his microphone is not working, so I will read it out to you. So, Michael, do you agree with the thesis that financial repression is the likely way forward for governments worldwide over the next few years? If so, what is your advice for asset allocation in that environment?
Okay, it's a very good question. financial repression, answer yes. But let's think what financial repression means. Financial repression basically means an attempt to reduce the debt GDP ratio by sort of, let's say, foul means rather than fair means, by pushing the rate of interest on debt way below the rate of economic growth. Now, the difficulty in doing that is that governments can't create GDP growth; they have to accept it, and the level is already dictated by underlying productivity growth, and that we know is relatively low. So that means that interest rates have got to be kept low for a long time. But rather more than that, there are two other dimensions. One is that they can persuade or force financial institutions or in extremist households into low returning assets. In 1933-34, the US government banned individuals holding gold under the threat of very serious jail penalties if they were caught with holding gold. Gold had to be sold to the Treasury, which gave the US Treasury a wonderful windfall gain, which enabled the Depression to end in the mid-1930s. A more prosaic example is what they could do to banks. They could force banks to hold more government debt, or they could force pension funds to hold more government debt, etc. And that's clearly one restriction that could occur. But the other thing that I mentioned is yield curve control, and that will be another mechanism trying to cap long-term rates. But I've tried to point out that's actually very difficult to do. Now, in an environment where either you're capping long-term interest rates, you're making bond markets unattractive, or you're actually even allowing the yield on long-term bonds to rise in the medium term, you're really hitting investors with either short-term or long-term losses. So I don't think bonds are an area that you want to be anywhere near on a medium-term view. Equities are really the only asset class that will come out of this well in terms of financial assets, or as George Noble pointed out, gold is by far and away the sort of the no-brain asset to hold in an environment where there's a lot of uncertainty, where there's huge monetary creation, and there's uncertainty both about the inflation outlook and even the sort of integrity of debt on the financial system in the medium term. And just remember, gold is not about cost inflation. Gold is all about monetary inflation. And monetary inflation is what we've got. We haven't got cost inflation yet. We've only got cost deflation. But monetary inflation is what drives gold.
More okay, questions? Perfect. I think George Noble has another one, so I will patch him through again. George, over to you.
So, Michael, you're just one last thing, just elaborating. When you said, I mean, we were agreeing on gold. So when you say you're looking at the gold to oil ratio, that's telling you that it has to go a lot higher. Is that solely because of your view on gold, or is there some other thought behind that statement?
So was it about yuan gold? Did you say?
No. The gold. I think you said the gold oil ratio has to go higher.
Yeah, I think the gold. I mean, I think that where we were starting from was a relatively low gold oil ratio. So what I was saying was from looking over the last few years, gold had basically remained relatively low against oil. And I expect a higher ratio. So I think that should be in play anyway. But we know on top of that the gold price should be going up. So if you've got a rising gold price, a rising gold oil ratio, oil will be affected to some extent, but it's not going to rise to the same extent as gold does. If the
right.
price goes up, gold oil ratio stays where it is, oil will go up.
That's fair enough. And then just one last thing, sort of an offshoot of that question. So in the short run, everyone's worried about deflationary consequences, and you look at some of the price indices, and they clearly are showing deflation. Looking out a bit longer, as you pointed out, it's potentially quite inflationary. So I guess it's a question of your time frame, what the market's going to focus on. Right now, it's worried about deflation, it's the bonds rally. Looking out, clearly there's inflationary potential. So is it just a question of multiple time frames? And I mean, how would you navigate this? Would you wait to go short bonds, or would you wait to buy the inflationary beneficiaries?
Yeah, I would. I mean, I think one has to be guided by charts in terms of momentum in the short term on this, because it's an uncertain period. But I think the best analogy or period to look at as a benchmark is the period from 1945 to 1951 in the US, where there was this period of yield curve control or financial repression, maybe similar to what we're seeing now. But the key point was that the Federal Reserve, when it was targeting the long end of the bond market, lost control of the price level in the US. So in 1947, I believe, or 48, there was price deflation in the US. And by 1950-51, there was very significant inflation of the order of 10%. So prices actually fell, I think, by about 4% in 47, 48, but they were rising at 10% by 1950. And monetary growth, if you look at the monetary growth figures, or even base money growth, it accorded exactly with that movement in prices. So even though you were running through a period of yield curve control, supposedly at that time, the monetary rules still applied. And that said that monetary growth causes inflation and declines in money growth cause deflation.
Yeah, and then just adding on to that, if you look at it from the standpoint, as you rightly pointed out, and I thought it was brilliant, your rendition at the outset showing the stock of debt and whatever. I mean, the central bankers, they really do want inflation. I mean, that's the only, you've got to deflate the debt. No, I mean, ultimately, it's the only way out. I mean, they want inflation. They're desperately trying inflation. But so far, all they've managed to do is, as you say, over the years, have been producing monetary inflation, so financial asset prices have gone up. So they need somehow to reflate the stock of financial assets, and in the process, they may do the real economy as well. But so ultimately, don't they want inflation? I mean, that's the only, you need to devalue the debt.
Yeah, exactly. I mean, that's right. I mean, I think there is a mindset going on, a mindset change with many governments. I'm not going to say necessarily in the Eurozone because I don't know that for sure, but I think in the US and the UK definitely. And I'll give you one anecdote which shows how the mindset is that this is purely an anecdote. It was a friend of mine who was involved in procurement for the government, and he advises on things like recruitment or planning for recruitment of key workers. And one of the remits that the UK government has got is to basically hire 20,000 more police. Now, he's been told by the Cabinet Office, get on with it, okay? No holds barred, just go off and recruit. You've got to find them 20,000 police.
Thank you very much.
And what he says is that's not the hard part. The hard part is for every you have on duty, you have 8 support workers. So what the spending basically entails is to put 20,000 cops, or whatever the number is, 8,000, I think, rather, 8,000 cops on duty. You need 8 that in backup. So the spending commitments and the unproductive spending that's going to take place in the next 2 or 3 years is awesome. And that's why inflation could be a problem.
Brilliant. Thank you.
Okay, any
Tom,
more questions? Any more? I don't think so. Well, thank you very much to Michael, and thank you very much to everybody who joined us today. As said at the beginning of this conference, there will be another one at the same time next week, which will be geared more towards Michael's new book, which is entitled Capital Wars. I will be sending out a few emails about that and links to that conference. But feel free, if you have any more questions that you can't think of right now, feel free to email me and I'll get them over to Michael. All right. Thank you very much, everyone. Thank you. Thank you again,
Thanks for your
Michael.
time. Bye-bye.
Cheers. Bye.